Hey everyone, we're here for our next session, which is with Shayan at Cointracker. He's the head of tax, and he'll be doing a talk on cryptocurrency and the IRS, what no one knew about taxes. And I'll let him take it from here.
Yeah, hey, thanks. Thank you everybody for attending this session. So I'm gonna try to keep this very informative to you guys. There's a tax deadline coming up, and after a few months, there's going to be another tax season. I'm sure you guys went through the whole drama that we had in 2021. We had NFTs, yield farming, and crypto going up and down. Bitcoin setting up the highest, all-time high. So yeah, in this presentation, I'm going to talk to you about taxes in general and some tax saving tips and etc. So quick intro to me. My name is Shihan, CPA, head of tax at Cointracker. I'm pretty active on Twitter. Some of you guys might have seen me there. My handle is at the Crypto CPA. So if you have any questions, feel free to send me there. Objectives. So three things in the next half an hour or so. We're going to talk about crypto taxes and new developments. And there's a lot of things happening in the Congress and the IRS. As you guys know, the infrastructure bill is being negotiated and is being finalized. And there's some implications that you should know. And there's certain time windows that you need to know. Like if you were to, for example, do some wash trades before the end of the 2021 year, those would be valid. But if you were to wait after that, those might not be valid. So things like that, we're going to be covering those things. We're going to cover tax saving opportunities, and also finally, how tax software can help you stay out of the IRS trouble. Want to give you a quick disclaimer. So tax laws are extremely complicated. If you have specific tax situations, I encourage you to consult your own tax, CPA or an accountant. And this presentation is solely for education purposes only. Okay, so where are we now? So I'm not going to go through all these milestones, but this kind of shows where we are in terms of the accounting and tax compliance. As you guys know, Bitcoin, came into circulation around 2009, 2010 time period. IRS came into the picture in 2014. In my opinion, that's when IRS kind of started, looking in this space. And then they issued this, notice saying that IRS, treating cryptocurrencies as property. And over the years, we saw, subpoenas being issued to exchanges like Coinbase. And then in 2021, we saw 2 subpoenas going out to, Circle and also Kraken. I'm sorry, the Circle and Poloniex. And then 2020, we saw this major change in the tax form 1040. I'm sure if you guys filed the returns, you probably had to answer this question. So the question is at any time during 2020, did you receive, sell, send, exchange, or otherwise accrue any financial interest in virtual currency? Let me kind of talk about this question because a lot of people are afraid of answering this question. It's such a broad question. So if you're in crypto in some way, it's really hard for you to say no for this question. The only situations where you could safely say no for this question are twofold. Situation one is when you purchase crypto using USD or any type of fiat. If that's the case, you can say no for this question according to the IRS FAQs. The other situation where you could say no for this question is you purchase crypto before 2020, like 2019 or 2018, and during 2020, you didn't do anything with crypto. So in that case, you could say no because the question targets only your 2020 activity. The other thing to note is that just because you say yes for this question, it doesn't mean that you're going to get instantly audited next day. Just be truthful because you're signing the return under penalty and perjury. So if you trade crypto, if you receive staking income, or if you received an airdrop, if you received a gift, make sure to say yes for this question. And saying yes doesn't mean, one, you're subject to an audit next day. 2, it doesn't necessarily mean you had to pay taxes either, because there could be situations where you're receiving crypto, for example, like a gift. You had to say yes because you received crypto, but there's no taxes associated with that. Okay, so let me kind of talk about taxes at a high level, and also during the last 5 minutes or so, I'm happy to answer your questions as well. So if you have any specific questions, just use the chat feature. I'm happy to answer those questions as well. So taxation, I guess the main takeaway is that even though we call cryptocurrency a currency, it's not taxed as a currency, it's taxed as property. The taxation is very similar to stocks and securities. So you have a purchase price, you have a sales price, and if there's a positive difference, we call it a gain, and that's subject to, in most cases, capital gain taxes. Now, the next question that you guys might have is, okay, I know I have crypto, but when do I have to pay taxes, or when do I have a tax obligations? So these are the 5 situations where you could have a tax obligation related to crypto. So number 1, when you sell crypto into fiat, it's pretty self-explanatory. Say you got Bitcoin at $10,000, now it's trading at 50,000. You cash out for 50,000. You got to pay taxes on $40,000 worth of gains. And number 2, this is where a lot of people don't understand how tax laws work. You also have tax obligation when you exchange one cryptocurrency to another. Say you had Ethereum, and Ethereum now it's appreciated, and then you're selling that coin and buying Bitcoin or vice versa. So you're just going from one cryptocurrency to another. So that also a taxable event. In that case, obviously you don't receive the cash, but the IRS doesn't care whether you receive cash or not. According to them, that's a taxable event. So something to be really careful about. Number 3 is when you spend cryptocurrency to buy a Tesla or a service. If you could be paying like a contractor for building a software or something like that, or even buying an NFT, which has become very popular. Those things do create taxable events because when you spend, you're spending an appreciated property. So because of that property treatment, whenever it goes out of your hand, it creates a taxable event. Number 4, when you earn cryptocurrency, so you could be earning cryptocurrencies through wages, staking income, mining income, or interest income. Those situations, create taxable events for you, and you had to track those income and kind of report it towards the end of the year. And then finally, airdrops and hard forks are, again, the question a lot of people have with airdrops is that, okay, I never asked for this airdrop, I just got an airdrop and I didn't really ask for it. Again, it doesn't matter to the IRS, whether you needed that or not. If that hits you, if an airdrop hits your wallet, that triggers a taxable event, unfortunately. So remember these 5 things, and these are the 5 situations where you could have a potential crypto tax bill. So now that you know when you might be subject to crypto taxes, the next question you might have is, okay, what kind of taxes do I have to pay? It's not an easy thing to answer in just one slide, but just so you know, a lot of investors are subject to capital gain taxes. When you sell, their property, applies to cryptocurrencies, NFTs, stocks, and etc. So there are 2 types of taxes. So when you sell your crypto, after holding it for less than 12 months, it triggers ordinary income taxes, and the rates are on the left-hand side of the slides. It's progressive. So the more income you make, the more taxes that you will have to pay. Ordinary taxes are also triggered by when you receive mining income, staking income, interest income, and getting paid in crypto wages, airdrops, and hard forks. Now, if you move to the right side, you can trigger long-term capital gains when you sell your crypto assets after holding it for more than 12 months. As you can see, the long-term capital gains are very beneficial because the highest long-term capital gain rate is 20% versus the highest short-term capital gain, short-term ordinary income tax rate is 37%. So it's something to keep in mind. Whenever you sell something, make sure to sell stuff that you have held for at least 12 months. By doing so, you're naturally reducing your tax bracket significantly. Okay, NFTs. So let's talk about NFTs because I think it deserves its own slide because in 2021 we saw a surge in NFTs and a lot of activity. NFTs are taxed, very similar to cryptocurrencies. To be very, very specific, NFTs, especially these NFTs, like artwork-based NFTs, they're taxed as collectibles under the IRS tax code. Therefore, if you're a very high income earner, those gains are subject to the 28% tax rate versus the 20% maximum tax rate that regular cryptocurrencies are subject to. So that's a slight, that's the only difference between the taxes between cryptocurrencies and NFTs. So something to keep in mind. Number 2, so buying an NFT is a taxable event, as I mentioned earlier, because when you buy an NFT, you typically spend Ethereum. So that's triggers taxable event. And of course, selling the NFT is a taxable event, obviously, assuming you have a profit. And earning royalties is also a taxable event every time you receive those royalties. So something to keep in mind and something you need to track and report in your next year's taxes. Now, the taxes slightly vary depending on your activity and how you interact with these NFTs. You could be an investor. Investors are, people who buy and sell NFTs. Creators, these are the people who kind of mint NFTs and they're artists. So depending on your role, your taxes could vary. So I'm not going to go into, deep dive into those, differences, but I wrote this guide, NFT tax guide. So it's a free link. If you go there, you can see the taxes for investors and creators and what you need to do to track these things to file your taxes properly. Okay, so far we spoke about crypto. So we know they're taxed as property. We know what kind of taxes they're subject to. We also spoke about NFTs. Now, again, I'm just answering an FAQ here. This is a question that I get all the time. The question is, okay, crypto and NFTs and etc. It's a whole, decentralized, right? I mean, how does the IRS know if I do anything with crypto, if I have any tax obligation? So these are some of the ways that the IRS knows that you have something to do with cryptocurrencies. So number one, if you receive like any type of 1099 form from an exchange, it could be a 1099K, 1099B, or 1099 interest, or 1099 miscellaneous form. That means that exchange has already reported your activity to the IRS. And when you file the return, and if you don't include that amount on your return, IRS knows that because IRS matches what you reported on your return with what exchanges have reported to them directly. So if you receive a 1099, that means IRS knows your history, your gains, and etc. So make sure to report it correctly. If you don't report it, you're definitely going to get a notice. The second way that the IRS knows about your crypto activity is through subpoenas. IRS used this method very effectively. Several years ago, IRS issued subpoenas for Coinbase. In 2021, there were 2 subpoenas went out, one for Poloniex, the other one, I don't remember the name on the top of my head. So expect, and if your name is included in one of these subpoenas, then IRS knows your trading history and etc. So that's another way. Number 3, we just discussed a few minutes ago, when you answer that, Form 1040, the crypto tax question, obviously you may not have, taxable events for that tax year, but IRS probably has like a database that has all that information and all the people who said yes for that question. So in the next future, future years, I'm sure they will be expecting those people to have some type of taxable transactions because they said yes at some point in their history of tax returns. So something to keep in mind. Number 4, through blockchain analytics tools like CipherTrace and chain analysis, and IRS work with, especially chain analysis, very closely. They have developed systems to tie online anonymous pseudo-anonymous transaction IDs and wallets to real world people, and IRS has captured a lot of criminals this way as well. So these are the 4 ways that the IRS knows you have something to do with crypto. The point that I'm trying to make here is that a lot of people think that crypto is anonymous and therefore nobody can come after you. But there are a lot of ways that people can find your true identity. So my advice is to, just, report your taxes correctly. And whenever you can, you should use all the tax savings and planning tips to legally reduce your tax bill. And we will cover some of those in the coming slides. Okay, IRS Latest Crackdowns. So speaking of IRS, in my opinion, IRS is more bullish on crypto than anybody else because IRS is looking for money, right? They're a business that's in the business of collecting money, and they see crypto going up. As crypto goes up, people who had $100,000 to $200,000 worth of net worth, they are becoming millionaires, and some millionaires becoming multimillionaires, and multimillionaires becoming billionaires because of crypto. So whenever there's wealth creation, that's great for the IRS because that means those wealthy people had to pay more taxes. So IRS sees this space as a growth space for them because there's a lot of tax revenue in this space that's going to go towards IRS in the next coming years. On the first point, so in January 2021, IRS publicly announced that they deployed this operation called Operation Hidden Treasure to specifically, catch crypto tax evaders. This is a joint effort between multiple departments of the IRS, so watch out for that. So this is not a great time to not report anything, because IRS is super interested in this subject, because there's a lot of money for them, waiting on the sidelines. Okay, so here's a quick summary about what we kind of discussed. Again, I'm not going to go through like all these things, and this slide again, if you want these slides, I'll happy to share these. And all these things are linked to certain blog posts that I've written about. Like if you want to learn more about how mining taxes work and airdrops and etc. But the TLDR here is that just remember those 5 situations where that you're subject to crypto taxes. Typically, most people have to pay capital gain taxes, and there are 2 types. Short-term capital gains. The rate range from 10% to 37%, and in the long-term capital gain, the rate ranges from 0% to the maximum 20%. Okay, so getting paid in crypto. So I want to cover this because there are increasing amount of startups and businesses that allow people to get paid in cryptocurrencies. Something to keep in mind is that you have to report this income even if your business or the employer doesn't issue any type of 1099 form or W-2. The amount that you report is the market value of the coin at the time you receive it, and that would go in your taxes. And remember to withhold federal and state taxes, because when they send those rewards directly to your wallet, they're probably not going to send your share of taxes to the IRS, similar to when you get paid your W-2 or like a paycheck, they send a portion of that taxes to the IRS directly. But in this case, they're probably not going to do that. So it becomes your responsibility to calculate it and send it to the IRS and the state government, and make sure you keep good records. Okay, IRS tax letters. So I want to talk about this because these are very scary. I mean, I've dealt with hundreds of crypto taxpayers who have received these, and some people receive this even if they do report everything perfectly fine. IRS started sending these letters to kind of educate crypto taxpayers, saying, okay, crypto is taxed. This is how it should be taxed. This is where you should report things. If you didn't report anything, this is the time to amend, and etc. So that's what pretty much these letters communicated. So there were 3 types of letters. So in case you're curious, if you click the links, you can see how these letters look like. Letter 6173 was some sort of a serious letter. So if you receive it, you had to respond to that letter within 30 days. If not, IRS is going to escalate your situation to an examination. So then at that point, you're going to get subject to like a proper audit. Letter 6174 and 6174-A, these are educational letters. So this is just to kind of educate you, but at the same time, they know that you have something to do with crypto. And you could see other letters like CP2000, etc. The point that I'm trying to make here is that you're going to see these letters coming up in the next coming years. This is as a result of the subpoenas that were issued to a couple of exchanges in 2021. I'm pretty sure IRS still has information that they gathered from Coinbase back in the day. So don't be afraid. And some of you guys, may have filed everything perfectly fine, but you might still receive these things. If you receive these things, I wrote this guide on like how to successfully defend yourself. If you click IRS Crypto Tax Letter Guide, like you can see what needs to be said on that letter. There's a free template that you can use, and also what needs to be attached to that letter to kind of prove your case. And these letters are not only limited to US. We saw ATO, Australian Taxation Office, which is the IRS equivalent over there, sending out these letters to 350,000 users. So you're going to see more of these in the coming years. Okay, so statute of limitations. So if you were to ask me what the most important slide of this entire presentation, I would say this. And this is something that a lot of people are not aware of, because this is somewhat technical. So statute of limitation is this legal concept that gives the IRS the legal right to audit somebody. Just because they're IRS doesn't mean that they have all the rights. Just because they're IRS doesn't mean that they can go audit anybody whenever they want. And if you know these rules, you can successfully reduce your risk of getting audited. So let me explain what I mean by the statute of limitation. So there are three things: 3-year statute, 6-year statute, and the forever. So the 3-year statute means that if you properly file a tax return, IRS legally only has 3 years from the date of filing to come and audit you. If you understate your income by more than 25%, that statute goes from 3 years to 6 years. So IRS can come after you for a longer period of time. Now, here's the kicker. If you don't file any tax return, IRS can come after you anytime, in 2050, 2060, or whenever, because you never started the statute of limitation by filing a return. So this is why filing something is better than filing nothing. Because as soon as you file something, you start the statute of limitation and you start the clock, that 3-year clock. And after that 3 years, IRS cannot come after you legally. So something to keep in mind, just file your returns. So you start the statute of limitation. So you give the IRS the least amount of legal time as possible to come and audit you. Okay, so that's some taxes and overview. So in the remaining of the slide, I'm going to talk about tax planning. So tax planning is a nice, better way to save, how to save taxes. So when it comes to saving taxes, there are 3 things that you can do. You can eliminate taxes, you can reduce taxes, or you can defer taxes to future years where your income tax bracket's going to be lower. So obviously elimination would be amazing, but other 2 strategies are great as well. So let me walk you through some things that you can actually implement very easily. Okay, so tax loss harvesting. Some of you guys may be aware of this, but this is a situation where you have a certain coin or an NFT. That coin or NFT is market value is below the cost basis, meaning you paid $1,000, now it's worth, let's say, 800. So what you can do is you can sell that coin and harvest that $200 loss and buy back the same coin or an identical coin at the lower price. So what you essentially did was you harvest that tax loss, the $200 loss, and that loss can be used to offset your crypto gains and stock gains, and even in some cases, your W-2 and other income as well. So this is a great strategy for you to use. I mean, maybe every quarter you should look at your portfolio and see which coins are in the red, meaning market value is below the cost basis, and you can sell them, harvest the losses, and you can do it every month, every quarter. So by the time you file the taxes, you have a big chunk of these losses ready to offset your gains this year or in the future years as well. So very powerful tool that you can use, especially if you're using a tool like Cointracker. We kind of show you all your coins and which coins that you can tax as harvest on and your potential savings. Now, the second one is actually even more powerful. So FIFO, LIFO, and HIFO. So FIFO stands for first in, first out. LIFO stands for last in, first out. And HIFO stands for highest in, first out. So these are called accounting methods, and these methods signal the IRS which specific unit that you're selling for tax purposes, not in the real world, for tax calculation purposes, which specific unit that you're selling. And it's pretty important because depending on the specific unit that you're selling, you can control the resulting capital gain or capital loss, right? Because ideally what you should be selling all the time for tax purposes is the unit which you paid the highest amount, meaning you have the highest cost. When you do that, you naturally reduce the delta between the sales price and the cost basis, and that results in the least amount of gains. So obviously to do something like that, you definitely have to use a crypto software because it's really hard to do this manually. It's virtually impossible, to be honest with you. So if you use a tool like Cointracker, you can just switch between these methods and see which results, which method results in the least amount of gains. Typically, for 99% of the people, HIFO results in the least amount of gains. But there could be situations where FIFO and LIFO could be useful for you as well. So these are very two powerful strategies you can implement at any time to reduce your tax bill legally. Okay, the other thing, again, another not very well-known area. You can actually pay 0% tax on your long-term gains only if you meet these criteria. So if you look at the chart, if you're single, you can exclude from taxation up to $40,000 worth of long-term gains. And if you're married, you can literally cash out $80,000 worth of long-term capital gains and pay zero taxes. Just know that this 80,000, it has to be your overall income for that year. So meaning like you cannot have your entire income should consist of long-term capital gains in this case. But if you have a large, unrealized capital gain portions, every year you can cash out up to 80,000 in long-term capital gains and effectively pay zero taxes. So that's actually like getting paid 100,000 every year, because 80,000, like you're paying zero taxes. So something to keep in mind. But in order for you to be eligible for that, you have to sell the long-term assets, meaning the assets which you held for more than 12 months or more. Donating crypto is another way to save your taxes. So when you donate things, you get two benefits. Number one, you bypass the entire capital gain in the appreciation of that asset. And number two, you get a write-off for the donation equal to the market value at the time you're donating to the charity. And that write-off can help reduce your regular W-2 income, crypto income, stock income, and etc. So very powerful tool. This is one of those few situations where that through one transaction, you can trigger two tax benefits. First, you bypass the capital gain, and second, you get a write-off. Self-directed crypto IRA. So these have become extremely popular. So these are special type of IRA accounts where you can create, mine, and even stake in some of these IRAs. And you don't pay taxes today. Taxes are deferred to future years. And hopefully the idea is that you take the money out when you're old, and hopefully by that time you're subject to a lesser tax rate than it is today. Okay, so those are some tax planning and saving strategies. So we are getting towards the end of the slide. So before I close out and kind of answer some of their questions, I want to kind of mention about Cointracker. So as you guys know, Cointracker is a platform that helps you calculate your crypto taxes. You can connect your wallets and exchanges and etc. And we support over 300 exchanges and 8,000 plus coins. So it's just a matter of you connecting all your sources of income in the crypto space, and we calculate your crypto taxes, and we give you the forms that you need to file with your taxes. So if you're listening to this, there's a 10% discount code. Feel free to use this, cointracker.io/A/dystopian labs. That's going to give you 10% off discount for you. So takeaways before we go to the questions. Make sure you calculate gains and losses using some type of software, because it's virtually impossible to do these things manually, but IRS expects you to do these things correctly. If not, you're probably going to get a tax notice, most likely. Number two, I know paying taxes suck, but there are tax saving opportunities that I described that allows you to eliminate, reduce, and defer. Among those things, I think the two things that you should probably focus more on is taxes harvesting and picking the right accounting method, ideally the hyper accounting. And last but not least, make sure you file something to start the statute of limitation. Don't wait until. Don't think that not filing anything is a good thing. The not filing anything is the worst thing that you can ever do. Because you didn't file anything, so you didn't set a statute of limitations. So you're giving IRS unlimited time to come and audit you, versus filing something and giving IRS the least amount of time to come and audit you, which is the 3-year period. Okay, so before we go to Q&A, I want to say thank you. And in the slides, I'm happy to share this if anybody's interested. There are some guides that you can read to be more familiar with some of these other jurisdictions and margin trading, etc. as well. All right, so let me stop sharing my screen and see if you have any questions. Okay, let me, 1 second. All right, what is this guys to handle again? It's their crypto CPA. Okay, so thank you, organizers, for putting that link. Okay, but how would they even know you're moving from one token to another? It's not even the legacy bank's currency. So they wouldn't know, like, think about it. If you're swapping something inside MetaMask, I guess nobody knows at that point. It's safe to say that. the way that they know is through when you on ramp and off ramp fiat, and also like if your activity raises to the level of some type of illegal activity, then they have sophisticated technological tools to kind of see what's really going on and why is there a lot of transaction going in and out. Why you're converting your money to Monero or something like that all the time. So to answer your question, they wouldn't directly know what's happening, but but I wouldn't take that I wouldn't take that chance and not report anything. Okay, so what happens if you deposit to a centralized exchange, lose some of your money, and want to withdraw it to a bank again? You still pay tax even though you lose percentage, right? Okay, so here's a situation where you put some money into a centralized exchange like Coinbase and you trade, and then you lose some of those gains. In that case, you don't have to actually pay taxes. Actually, you get a loss, which actually helps you in taxes because that loss you can use to offset your future crypto gains and also your stocks and security gains. So if you lose money in a trade, you don't have to pay taxes. Okay. Okay, how does Cointracker handle like-kind exchanges or 1031 exchange? So for those of you who don't know, 1031 exchange is a situation where you can exchange one property with an identical another property, subject to a lot of rules and etc., without paying any taxes. Unfortunately, 1031 exchange is not available for crypto. IRS has been super clear about this for a long time. So to answer your question, crypto to crypto trades are treated as taxable events in Cointracker and every other software that I know. How can we access the guide? What I can do is if you can send me a DM on Twitter at the crypto CPA, I'll put the link for you. Would I benefit from creating a business entity to protect from taxation? Not really. The business entities are taxed, especially LLCs are taxed at the personal income tax level. What they will allow you to do is increase the protection of the asset that's inside the business. So it's not going to help you in taxes. When it comes to asset protection, LLCs will help you. What is the best way to track and report DEX transaction, pancake swap for tax purposes? I would encourage you to use a tool like Cointracker and connect the wallets, and yeah, it should track it. Will you cover the top best jurisdictions for tax? I mean, when it comes to US, like when it comes to tax, I mean, there are like a handful of states with no state income taxes, like Wyoming, Texas, where I reside, Florida, etc. So those are good regions. Outside of the US, I'm not an expert there, but a lot of people are moving to Puerto Rico and Portugal because of some of the incentives that they have. Okay. Tax losses. Can you sell at a loss, exchange for fiat, and take losses on taxes? Simple answer is yes, you can. Self-directed Roth IRA is for tax-free income. Yes, you're absolutely right. If you can do that, yes. Would be great if you share the link. I'll try to do. Yeah, actually, let me do this right now because I see a lot of requests. So give me 1 second. I just put the link on the chat. So. Okay, so I think we're coming towards the end. So let me answer the final question. When you issue a token, how do taxes work? What are all the things you should think about? So so this is a question that we really need to get into the weeds, like how it is structured, what kind of entity that's issuing the token, what the token is trying to do, and etc. So okay, high level. Most likely when you raise money through like a token, that I believe that's what you mean by it, that's not a taxable event, but that statement has a lot of exceptions and exceptions to the exceptions. Okay, so let me answer one thing. So, okay, liquidity pools and taxable events, very, very complicated, especially Uniswap, where like, when you put some money, the ratio changes all the time. One approach is to kind of take a P&L approach, meaning you have an entry price to the pool, and then when you close the pool, you have an exit price, and the difference would be, considered like a profit and loss, and you would pay taxes on that without necessarily, tracking every single thing that's going inside the pool. So, but again, it depends on the pool. I think that's all the questions that we have, and we are also, reaching the 30-minute mark as well. So I thank you very much for attending. If you guys have any further questions, feel free to reach out to me on Twitter.
Thanks so much. This was a fantastic talk. I learned a lot. We're going to transition to next session now. Thanks again.